Hey guys, welcome to Investor Insights by SRU. Today we're covering an investor letter from Morgan Stanley. It's called Be Careful What You Wish For. And before we go too far, make sure to subscribe and also follow our Instagram channel. It's instagram.com/Silver Report. Be careful what you wish for. It would be hard to find a more maligned group than the Fed over the past year. Even the Fed itself admitted its transient call on inflation was wrong. In an effort to regain credibility, it has swiftly pivoted to the most hawkish policy action in a generation. While our fire and ice narrative assumed the Fed would have to be aggressive in 2022, we never expected to see a hiking cycle this severe. Kudos to Jay Powell and the Fed for taking such quick action and admitting their mistake. Suffice it to say, their efforts didn't go unnoticed. Both stocks and bonds having their worst start to a year in decades. However, since peaking in June, long-dated treasuries have had one of their strongest two-month rallies on record. Meanwhile, the yield curve is inverted by as much as 44 BP. Perhaps more importantly, market-based inflation expectations have fallen sharply and now sit much closer to the Fed's long-term target of 2%. Right or wrong, it appears that the bond market has quickly turned from vigilant to a believer that the Fed will get inflation under control. Meanwhile, U.S. stocks have rallied too. They're also up significantly from the June lows. In short, the equity market appears to agree with the bond market's view that the Fed will tame inflation and can soon pause its rate hikes, which is good for stock valuations. As we've highlighted for the past 2+ years, this economic cycle was likely to be one of the hottest but shortest on records. It all started with the explosive V-shaped recovery from the COVID thanks to the extraordinary fiscal and monetary stimulus as government decided to lock down the economy. In April 2020, we made the case for the helicopter money would likely lead to a surge in inflation, just as Milton Friedman suggested it would. And if it were ever tried, we also argued that it would lead to outsized earnings powers by many companies as the newfound surge in demand came while the government was effectively subsidizing labor costs. Such a combination led to an unprecedented and unexpected operating leverage for many companies. Most investors, including us, underestimated just how bullish the outcome would be for earnings and stocks indeed. These higher prices dropped right at the bottom line and inflated profits. Further complicating matters, this demand surge was temporary for many companies. Yet the consensus believed it only affected a select group of these winners, instead concluding we had entered a new, higher plane in demand and profits. Wrong again. Then the Fed really spoiled the party by saying it was going to do whatever was necessary to get inflation under control. Valuations collapsed for stocks, with the PE ratio for the S&P 500 falling as much as 30% today. Equity investors, they seem to agree with the bond market that inflation has peaked, and thus the Fed doesn't need to go much farther. Consequently, price-to-earning ratios, they've expanded back to their 17.5x norms, and the fall in interest rates has brought them down. We agree with the view that the inflation has peaked. In fact, inflation expectations crested in April and are down considerably for all tenors. However, the equity risk premium is back just to 285 BP. Fair value is closer to 400 BP in our model. With 10-year yields already down considerably, it's hard to argue for higher valuations with earnings estimates and the PMIs falling. Therefore, the question equity investors should really be asking now is whether the falling inflation will be good or bad for profits. Our view is that the falling inflation will essentially have the exact opposite effect on profits than rising inflation did in 2020 and 2021. And the consensus is underestimating the negative operating leverage cycle that has just begun. Much of it is underestimated the positive operating leverage as inflation rose. The only question is, by how much? Meanwhile, the strong labor report on Friday suggests companies have yet to cut labor in an effort to protect margins, while simultaneously delaying any Fed pivot. In short, inflation is likely to fall from here. While it may be good for bonds and valuations, it will not be good for profits. So be careful what you wish for. This rally in stocks has been powerful and has investors believing the bear market is over and looking forward to better times ahead. However, we think it's premature to sound all clear simply because the inflation has peaked. The next leg lower may have to wait until September when our negative operating leverage thesis is better reflected in the earnings estimates. However, with valuations this stretched, we think the best part of the rally is over.